Hey, everybody. Welcome to the Closing Beat. Happy Thursday. Yes, it is Thursday. How are we doing out there? Hope all is good with you. We are financial advisors here at Jazz Wealth, and we like to talk about the markets. We like to teach in particular. Big focus of ours, and we're going to talk about a whole lot of different things here today, so we're going to dive right into it. First thing, market likes the idea that the debt limit has passed the House. Now, it moves on to the Senate on Friday, but that's pretty much a done deal, so we could largely just put this behind us now, right? Right? Well, there's a lot of little things inside of there. You've probably seen the headlines as far as student loan payments coming back due again. That is, unless the federal courts don't knock down Biden's rule there, which they're largely expected to do. So get ready to start making your student loan payments again. Also, some changes on welfare and food stamps and things like that. They have different names now, but some changes there. Nothing too crazy. Spending actually will be cut by just under 0.2%. Which really has no impact at all. So we just essentially raise the debt ceiling, and now all that fighting and positioning and posturing can all be put behind us there. We can now start to focus on the next Fed meeting, actually, which the next Fed meeting will come up in now 13, 12 days, depending on how you want to look at it there. You got a 77% chance of a pause in rate hikes. That is what everybody is assuming, is that we've peaked out. Right? I'm going to share some data here with you in just a second. The ECB vice president, the European Central Bank, overnight said that basically the rate hikes have hit their home stretch. So really clear over there. He's like, this is the home stretch for rate hikes. And he actually said quarter point rate hikes will be the norm going forward. So a lot clearer than our Mr. Powell over here anyways. Well, that news certainly helped, right? So we got some news out of that, and some obviously expectations of rate hikes starting to pause. So our bond market able to actually start pricing in a little bit of a rally coming out of this big decline here. Remember, as prices go up, yields go down. So if you are one who wants to spend some money and use debt to do it, you want that to go as high as possible. If you're a saver and you want high money market funds and CDs and stuff, well, you want that to go back down there. So we'll see what happens there. Likely to be sort of quiet for the next 2 weeks, right? Because the Fed's going to go into their blackout period, which means they won't speak. You won't see them giving conferences or anything. They'll have their meeting and announce their results as they do in secrecy there. China was the big mover overnight there. Actually, our best positions in our portfolios were Chinese education companies and then the rest of the big names out there as well. So overnight, the Chinese market actually started what we had finished here in the U.S. Very, very strong market and across the board over in China. Now, if we go look at the S&P, got a little bit of a rally here today. The breakout not giving up, doesn't want to fight back. Or it doesn't want to give up, I should say. And this is what happens. Let me go over here real quick. We'll go to the 5-minute chart, and I'm going to use the SPY so you can follow along here. This is the type of thing that happens when the whole market goes higher, right? Each one of these are 5-minute bars. Every 5 minutes, we're getting a report how the market did. And so each one of those showing a nice consistent rally higher and then some profit taking right at the end of the day. And who could blame people? We've been seeing that a lot lately. Now, we know that Thursdays tend to be one of the more positive days in the market there. If you look above or look over, you can see the S&P's average return so far by day of week. And we know we've seen it Tuesday, Wednesday, and this week is no different. Tuesday, Wednesday, weak. Thursday, strong. Friday, the strongest on average anyways. And that's what we at least have going on right there. I do want to point out that the retail individual stock picker, I've shared this one here with you before, that once COVID kind of made us all go back to work, people said, I'm not going to buy individual stocks. So in the blue, you got the NASDAQ there. Individuals or retail people just like you and me who would go out and buy individual stocks, that participation has dropped off a cliff. Same thing in the S&P 500. Money moved over to index funds. Well, for whatever reason, that's starting to change. Again, you guys are going back into the market on an individual stock basis and foregoing the set it and forget it index fund type route there. So indexed ETFs and index mutual funds, seeing a little decline in participation there. And where's the money going? It's going right back in individual stocks. Very common, and I suspect that AI has something to do with it, where people said, okay, the S&P can do whatever it's going to do, and I would normally buy and hold, but darn, that AI is so attractive. This happened during 3D stocks. This happened during the pot stocks. This happened during Bitcoin. This happened during every last thing that you can think of that was exciting. The dot-com bust there, the banking stocks, when they fell apart there, people go, that's interesting. GameStop, AMC, there's always something, right? So that's what's happening right now. And I just wanted to point that out to you in case you're one of them. I see you. See what you're doing out there. Let's take a look here across the markets and see what May look like. So we're going to go from the top down. So if you're looking at the major indices there, I'll use the ETF so you could follow along. I won't use any futures here just so you could play. The best performing, you might have been able to guess it, was the NASDAQ, 7.88% gain in the month of May. Year to date, that puts it up just over 30% there, and that was hands down the best performer. Second place, you actually got really the Russell 1000, if you want to look at indices there, but that's with a whole 0.47% gain. So first place, 7.88, second place, 0.47. Shows you just how impactful the tech stocks in particular had really moved the markets higher. If you look into various factors of the market, in particular, you could probably guess this too, growth stocks is where all the action is. For the month of May, you could use the IVW or anything you really like to look at S&P 500 growth only. That's like a subsection of the index there, 2.53% there. And it continues to be that anything related to dividends, safety, slow and steady, monthly income, anything like that, very poor. The DVY is a dividend type ETF. It's one of the more popular ones there. A little Dow exposure in there as well. And that's your worst performer, down 7.73%. In other words, people want the growth of AI. They want the growth of all the tech stocks that will still have to borrow money, but at higher costs. And of course, they're laying off people left and right. They don't want to be the steady Pepsi. You know, give me a JP Morgan in there. I'll take an AT&T while you're at it. That's what that is made up of, and so that's what you see. The worst sector for the month, if you're going to dig down from the index into individual sectors. So we did index, then we kind of went factor. Factor is a way of saying like dividend, value, growth, things like that. If you go down to individual sectors, there are 11 of them, and the energy sector is the worst performer. That has to do with a little bit with oil, so oil down about 10%, and then also natural gas down 11% as well, and that's down over 50% year to date. So if you like a good discount, I'm not saying buy it, I'm just saying that would be officially the most discounted thing that you could look at. Best performing sector you could probably guess is going to be tech. That has about a 9% gain, up 32% year to date. And in second place, also tech driven in here, is communication services. I'll move on from that because you guys know that, but consumer discretionary, 2.54%. That's a close third place right there. In other words, we don't want dividends. We don't want slow growth. We want stocks that perform when the economy is strong and getting stronger. That's what consumer discretionary stocks are. If you thought, I don't think that, I think the economy is getting weaker, that would be consumer staples stocks in there, which comes in second to last place, only to energy, as the worst performer. Another indication that people say, I want risk right now. If I'm going to invest in the stock market, I want risk. You know why that is? A little side topic here. If you're investing money in the market, you have that time to risk it. Maybe it's for retirement or for the long term or whatever it is. You want to take that risk. The reason why that's happening now is because if you don't want to take risk, you're as far away from the stock market as you can get. Because you don't have to be. I'll take my 5% in my money market fund. I'll go ladder some CDs and get a little bit better than 5%. I'll go do that, have really no risk at all. And then the money that's at risk, well, I want as much growth as I can get, and I don't care if it pulls back. So that's the mindset going on in the markets right now. Pretty clever. And you know, of course, with the fund flows that I've shared with you, that we can confirm that. All right, moving on around the world. Do you like your international stocks, do you? You're not going to like China if you're invested over there. If you're looking at China or even Hong Kong, I'm using the ETF, so you could take a look if you want as well. Those are the worst performing areas around the world. Brazil trying to make a little bit of a comeback there. So Brazil was a big high flyer about a year and a half ago, trying to make a little bit of a comeback there. But other than that, pretty quiet around the world. I would point out that Australia's had a little rough run, a little pullback inside of a sideways kind of consolidating trend there. Commodities, we don't have to go over them. It's going to be oil and it's going to be natural gas. Those are your worst performers. The best performer is still down. That would be gold. Remember when we talked about gold? Why would gold go higher? So hopefully that helped you when that time came up there. So just a little review. We don't always do that, but something to talk about there. Yeah, we're going to go there. Target. This just came up because I was looking at stats for stocks that have had a rough run lately, and Target would be one of them there. You know, probably through watching social media, what's going on with Target. Take your stance on that. It's fine with me. I'm going to look at the price of the stock. Today, thankfully, if you own it, broke a 9-day losing streak. Just to put this in comparison, Target doesn't do this. So this shows you how bad people think they messed up. The last time it had lost 9 days in a row and or lost that 20%, or 9 days in a row, I should say in this case, or more, I was in high school. And, you know, I don't know, I look young and all, but I was in high school. That was more than 22 years ago, just to put that into perspective there. So rather fascinating. Now, what do you do with that? Let's say you go, darn, there's got to be something there. I don't want to buy it. I'm a little nervous about what's going on, or maybe you just don't believe in them anymore. But you go, what do I want to do here? So I've done this before with Lowe's and Home Depot, like a pairs trade. And we've also done it with Hertz and Avis Rental Car, right? HTZ when they were around. And CAR is a ticker symbol there. A pairs trade. Here's what's going on there in Target, if you care about learning something just a little bit more geeky than most. Walmart and Target are paired together. They typically tend to be correlated. As Walmart goes, so does Target. Occasionally, one of them gets the upper hand for the moment and maybe has a better quarter than others, but historically, they trend together. Now, I'm only showing 1 year here, but if you were to zoom out, you would see that when one goes up, the other goes up. Some to, more degrees than other, but that's what's happened there. So we have more than a 15% spread. Now, actually, it'll be greater than that, a 35% spread almost, over just the last couple weeks, okay? This wide of a spread has happened less than 4 times ever in history between the pair. In other words, these stocks don't separate from themselves. Somebody messed up or somebody did well. That's all that can happen. Somebody's doing better or somebody did pretty poorly. In this case, it's Target. We already know it's doing pretty poorly there. So how do you trade this? I've done videos. You could search our channel for pairs trades or things like that, or just search for Lowe's, LOW or something. That you can actually play both positions and not profit from both of them going up or down, but profit from the spread tightening. We know that they don't like to be this far. Now, it could be that Target does something and all of a sudden it rallies back up. It could also be that things slow down and Walmart starts to fall. You're profiting from the spread. So a lot of times you will look and we'll say, we'll do this on a Jazz After Dark, actually. People will say, I'm going to buy a stock and I hope it goes up. I'm going to short a stock and I hope it goes down. Well, sometimes the stocks that are highly correlated, or a stock versus a commodity is another example, when they get sort of spread apart there, we just want to bet that the spread comes in tighter. And you can do that. You can use stocks to do that, or the individual positions. You can use options to do that. But that's what people are focusing on. And if you were to search, how would you do it? We have a system that does it. But if you were to somehow search the number of comments on Target pairs trade or pairs trade positioning or something, increase, right? People are now going, that's not normal, right? So we know people are about to go do that if they haven't already. So kind of cool, just something I would take a look at. Okay, also going back real quick, home prices. It turns out home prices haven't fallen as much as we thought, at least as of yet. Home prices and the Fed rate hikes. I thought, do home prices go up when the Fed stops raising rates? We've already done this for stocks. We've already done this for individual sectors. We've done this for commodities. Now I thought, let's do like weird stuff like houses and cars and things. Like if the Fed stops raising rates, which we predict that they will do, historically, do home prices go higher, lower, or sideways? So let's take a look. As rate hikes stop, home prices tend to go up, believe it or not, for the most part. So what we did here is we said, okay, let's start with when we officially know, looking back in history, that rate hikes had peaked. They stopped. And they didn't sneak another one in there. They just stopped. So whether that's this June or whether it's the next meeting in September, whatever, that's the peak. Now we look at home prices 12 cycles before, in other words, we're just using 12 months here, and then let's look 12 months after and see what happens. So I've got each one of them there. This is every time that the Fed, as far as I can go back anyways, has stopped raising rates. Now, we have presumably a peak. So that's in green, right? So we're saying, well, what could happen? Look through 95, 2018, 2006, and 2000. The majority of the time, you moved higher. If I were to just tell you the average return on a house price or growth on a house price 12 months later, it'd be a positive number. I'm just sharing each one of them with you there. So think about that. Why do we see an increase in home prices when the Fed stops raising rates? Can you take a guess? It's the same reason that we see tech stocks do well. It's the same reason that we see usually consumer staple stocks do well. So maybe there's some kind of viable pullback there. It's because if we know the cost to borrow, we can position ourselves to borrow. If we know the cost to borrow a house is, 6.5% right now, well, that sucks. We're used to seeing a 2 or a 3 in front of that number. And now it's 6.5% or 7 or whatever based on your credit and what you're buying. So if you know it's going to cost you 6.5%, you now can go, that's my cost, that's my payment. I don't have to wait for the Fed to raise or lower rates again. That's pretty much what they're going to do. And you make that decision. Am I buying that house or not? And if I'm going to buy that house, do I need to give up something in my personal finances to afford the house? Did I take a new job and I'm making more? Now you can more of a concretely kind of plan for buying that house. It's the same in the tech stock world. Right now they're like, I don't know, what do we raise more money? Do we issue more debt? What do we do? As we know that rates are going to be stable, now we can justify that in corporate earnings, but you're no different. It's your personal balance sheet. So that's probably why, if you ask me, that home prices tend to start gradually moving higher. I do not think under any circumstance we're going to end up with this 8% type rally in home prices. And remember, we're starting from a negative anyways. So we're starting right now from like a minus 2.7, right? So home prices nationwide have fallen about 2.7%. So, add 4% onto that. That's only growth of a total of 2%. So small increase. We're not talking about a whole lot of money there. Just kind of cool to take a look at that stuff. I don't know if you like that stuff or not. You'll let me know, right? I really just have, one other thing to share with you here today. This is going to be one of the better performers on the day. Chewy.com, you probably order from them if you have a pet or something like that. They said that their pet parent, that's what they call you guys, your pet parent is still spending wildly on your little fur babies out there, and you're not holding back on price. Okay, so combine that with the fact that they, I don't know if you know, have been automating the process. So if you have one of those auto ship, like I do this for my dog, we have the auto ship food. It just shows up. We just kind of know about how much we need, and it's automatic, and it comes from these guys. And if you do that, you get a discount, and it's like cheaper than you can go to the store to buy it. So you say, sure. Almost nobody touched that food. Fascinating. You can probably see it on YouTube here, but fascinating to see how that auto ship order just kind of makes its way into a box. Like the UPS guy is probably the first person to touch that box. It's fascinating. And so because of that, their margins are expanding rather quickly. Add to that, they mentioned a little bit more about Canada. I was curious to look at that. They've expanded into Canada. That was their first sort of international jump over the border, if you will. And as I was reading, I was like, okay, they said, Canada's going well, and we're shooting for U.S. type market share. Whoa, okay. I'd like to know more about that. If that's going well or even kind of according to plan, that's a huge extra source of revenue for them. That's probably what people were responding to today, is not the fact that the margins expanded a little bit, but hey, we've got a new audience here, new people that will likely adapt the same purchasing habits as others. People in Canada love their fur babies, right? The trouble with that is it won't show up on any of their earnings for the rest of the year. So it's before you go nuts and go, well, Dustin said, it's not even going to show up till the beginning of next year. It is not an easy and quick process to get into another country. All right, that's all we got for you here. Tonight on Wine and Wealth, what we're going to conquer is the discussion around your tax brackets and should you look at IRA versus Roth IRA contributions. And instead of doing like a general kind of video, we're going to go nuts with it. We're going to look back at all the tax brackets. We're going to break down the science of it, and we're going to see how do you specifically make that decision, or how can we, if you're a client, help make that decision for you so that you end with the most amount of dollars. Sometimes we talk about growth, sometimes we talk about planning. Tonight we're talking about taxes. We want all of your dollars to be as much as possible by you making the right decision now. And so we're going to break down all that geekiness. Got some good fun stuff for you. And I'll share with you how I got it as well, because it's kind of fun how we did that. Other than that, that's about all I got for you here today. I will appreciate you guys hanging out with us. We'll see you later on our Wine and Wealth if you're one of our clients, and hope to help you there. That's it. Have a good day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.